Is there a macro signal in Target's announcement today, or is this a one quarter, possibly two quarter problem that they're still working their way through there?
It seems more like a Target problem, not a macro problem. Keep in mind that Target just came 3 weeks ago, along with other retailers that had all cited that there is an inventory glut. What's changed in the last 3 weeks is likely Target-specific internal execution and them having to clear out more than they expected.
When, though, Mike, might we know if it's more than just a Target-specific issue? Because we're still buying stuff. We're just changing what we're buying. And I'm wondering how long that part of it, that we're still buying stuff, stays for.
Yeah, it's been interesting. We expected a much bigger switch to services spending than goods, but that hasn't really happened yet. We're still buying a lot of goods, which would be good news for Target when you consider the inventory situation. Friday, we'll get an interesting number, and that is the CPI for apparel. We've seen inventories rise significantly, and you can see in the last month, apparel prices started to turn down a little bit. If that's going to happen, that would be good news for consumers. But again, as Poonam would say, it may be just a Target thing, and it depends on what people want to buy within that category, as long as they're buying goods.
Absolutely. So what does this tell us about the consumer? Mike, where are we with the consumer? Some people tell me the consumer's in great shape, that we've still got a savings glut that we're going to spend. Look at what is happening with the airline story. People want to go out, they want to travel. Then I hear other people saying, well, this savings glut is being run down very quickly. The consumer's not worried about a recession, so it's comfortable doing that. Which is the right answer here? Where is the consumer? What's the right signal to take?
Well, somewhere in between seems to be the answer, Guy, because we are seeing savings run down. Last month, they fell to 4.4% was the savings rate. It had been as high as the 8s. And so there's a little bit less money in the accounts. But right now, so many people have jobs that they feel like they can keep spending. One interesting thing to watch for going forward is in the PPI, the Producer Price Index. We saw trade services, which is basically retailers. We saw prices go down in the last month. And that means margin compression. And so let's see if that continues when we get the PPI report next week.
Well, I think that raises the question, Poonam, is that how much more pain are these retailers going to feel? I mean, you see like Walmart in particular also down in sympathy with Target. Like, what changed in 3 weeks that they had to announce again?
Yeah, this is clearly an execution issue on their part because not much has changed in the last 3 weeks. We've known that there's been an inventory issue since February of this year is when e-commerce and retail companies started reporting. So it's really execution on their part. And, you know, where I think there's a load of inventory that they need to clear is in the home and electronics space, categories that had flourished through the pandemic. So probably they got ahead of themselves and ordered more than they could actually sell through this year.
Poonam, what happened to the second half? The company's guiding us back up to around 6% in terms of the margin. Looks like we're going to bottom out around 2. Is 2 the bottom, and how hard is it going to be to get back to 6?
2 should be the bottom. I mean, coming around at it the second time in 3 weeks, you would expect 2 to be the bottom. Getting back to 6%, listen, if once they get the inventory out, if they clear it by the end of the second quarter, then getting back to 6 is reasonable. Keep in mind, they had 8% profit margins at the peak.
Right, and it's just still part of the unwinding of the stay-at-home trade versus reopening. That still feels like what we're in the middle of. Mike, then I wonder, and this gets to a piece that John Authors wrote in Bloomberg Opinion this morning, is that can you have something like a hard landing for the equity market and a soft landing for the economy? And it feels like Target is a really good example of something like that.
Well, we can define a hard landing for the economy as a recession. I'm not sure how you describe a hard landing for the stock market because it depends on your tolerance for losses. You get to a bear market down 20%, that seems pretty bad. It doesn't look like we're going to have any kind of equity crash, but we are going to see companies struggle for a while to work through the remaining problems that come out of the pandemic and the things that are getting thrown towards us because of the ongoing war and COVID. I mean, we don't know exactly what's going to happen with inventories going forward because China, again, shut down so much of their exports. So we could see some additional problems along these lines. And it's going to be hard to tell when we're out of this. And also the interesting question that I can't answer, Poonam, the point that people are switching back from buying a lot of electronics and home goods because the work from home thing has sort of been fulfilled. But what is fashion going to be like? What are people going to want to wear? Are we going to decide that we are all more casual because we work from home part of the time? And retailers are going to have to adjust to that as well.
Well, this is the point, isn't it, Poonam? We are in a very uncertain environment, and we talk about the execution risk that is showing up in Target. I'm assuming other management teams are facing similar problems here. How easy is it to predict consumer behavior right now? We are seeing a huge splurge of a summer. Everybody wants to travel. There's backups in weddings. There's all kinds of things that we all want to go and do. The cost of living squeeze in some ways hasn't really bitten. I know we've got gas prices up around $5 a barrel, but there is potentially more still to come. How easy is it to predict the consumer going forward from here? How easy is it to predict for these companies where they should be investing in inventory?
Yeah, it's never easy to predict where the consumer is going for retailers. Keep in mind, they have to make these predictions 3 to 6 months in advance most of the time. So most of what you're looking to sell in the summer has already been placed back last year, and it's coming to stores now. In terms of, where the consumer is shopping, what they're buying, they're going out more. They are going out, and we're seeing that with fashion. Fashion demand has picked up. If the inventory isn't available, stores like Rent the Runway are doing well because they have the opportunity to deliver fashion in a timely manner, and it's at a value, right? If consumers are feeling that they want to spend a little less because they have 10 weddings all of a sudden to go to versus maybe 1 or 2 historically, where's that money coming from? They can't buy 10 dresses. So are they renting? Are they buying used? They're shifting. They're shifting where and how they spend too.